Okay, good morning, everyone. This morning I want to talk about what I think are probably the two main themes, the main secular themes in the market today, and I think there will be important themes going on for the foreseeable future. Now, the first one is the gap between the haves and the have-nots, the winners and the losers. And there's been a particularly stark contrast this year brought about by COVID. So on the one hand, you've got the Nasdaq, which is up nicely for the year, and the Nasdaq really represents the new economy stocks, technology stocks predominantly, whereas the Dow Jones is down for the year, and that the Dow Jones is made up largely of old economy, industrial type stocks. To further illustrate this trend, this is an extreme example of the strong getting stronger. And within the Nasdaq, the top 5 companies of the S&P 500, the largest tech companies in the world, have driven the bulk of the index's performance, not just this year, but really for the last 5 years. And it's been a massive divergence between the winners and the losers. Now, when a lot of people look at this, they think it's unusual, or they think it's strange, or it's evidence that there's something wrong in the world. But I would use a tennis analogy to kind of explain why I don't necessarily think that's the case. So if you think about Federer, Nadal, Djokovic, three of the greatest tennis players of all time. Between them, they've won 56 Grand Slams. And so if you look back from 2003, which is when Federer won his first Grand Slam, until today, those three players have won roughly 85% of the Grand Slams on offer. So that just says to me that they win because they're the best players, and winners tend to win. And we're seeing the same dynamic in the stock market. So I personally don't think that this is particularly unusual. So what's happening beneath the surface? So what's happening is that the strong companies are taking a greater and greater share of underlying economic profits, and they're doing that at the expense of smaller companies. Now, if you go beneath the surface, you'll see that within that top quartile of companies, it's really companies that rely on human and intellectual capital, and the companies at the bottom typically rely on physical capital and financial capital. So it really comes down to a battle between brains and brawn. And brains is beating brawn hands down. And I think it's in a really tech-enabled world where tech is becoming more and more important, and human capital is more and more important and leveraged on a global scale. It's my expectation that brains will continue to beat brawn. So just to go further on this idea of the strong getting stronger, and a small amount of companies, typically massively outperforming the rest. This is not a phenomenon that just relates to the last 5 years or this year. It's something that goes back much further. So there was a researcher, Hendrik Bessembinder, who did a study, and he looked at all the US stocks, that he looked at their lifetime returns between 1926 and 1916. And he looked at how stocks did versus short-term treasury bonds, so short-term interest rates. Do you get a better return out of stocks than short-term interest rates? And what he found over that 90-year period was that just 4% of companies accounted for all of the stock market's aggregate value creation. The other 96% of companies didn't contribute anything in excess of treasuries. So it goes back to this idea of a very, very small number of companies, that's very, very strong, make up for all of the rest. So I think the conclusion for me is, if you want to have strong investment results, then you really need to hold strong companies. You can't expect to hold weak companies and get strong investment results. So the first idea is this divergence between technology-enabled, human capital-enabled, strong companies and weaker, physical capital, companies that are dependent on physical capital. And there's a divergence that's broken out, and I expect that to continue. The second major theme is what I call PTSD versus TMAP. So PTSD is post-traumatic stress disorder. And I think, over the last 20 years, investors have been faced with a tech bubble and crash. They've had to deal with a global financial crisis. And then more recently, you've had the COVID crash. And for South African investors, it's just been even worse over the last 5 years. The market has been poor, and you've had various minefields like Steinhoff, for example. So it's been a very, very tough environment. And I think investors have a sense of anxiety, and every time the market slips a few percent, it feels like this is the big one, this is the next crash. On the other hand, you've got TINA, which stands for There Is No Alternative. And the problem that investors are faced with, particularly in developed markets, is that interest rates are basically zero. So if you are a pension fund or even an individual investor, and you need a 7 or 8% return a year to meet your financial goals and obligations, you're really faced with a challenge to get there. And so in this context, there's very little alternative but to invest in stocks. There are other asset categories, but they're typically really small or too small for institutional investors to invest in. And the next chart kind of goes somewhere towards illustrating the TINA point. So this chart, the dark blue line is the PE ratio of the S&P 500, so it's the PE ratio on stocks. The other line is effectively what I call the PE ratio on bonds. Now this is just the inverse of the bond yield or interest rate. So if the interest rate on bonds is 10%, then the PE is 10. If the interest rate on bonds is 5%, then the bond PE is 20. At the moment, with the US 10-year government yield sitting at roughly 0.5%, that means that the PE on bonds is now 200 times. So bonds are very, very expensive compared to shares. Alternatively, you can say that shares are very, very cheap compared to bonds. Now, what I think will happen is this TINA dynamic is going to force people more and more further along the risk curve, and I think that's going to drag the PE of stocks upwards as they seek out returns. I don't think that this is going to be evenly spread. I think your lower quality, lower growth companies will stay with the low PE, and I think your higher quality, faster growth companies will see their PEs re-rate upwards further and further. You're already seeing this today, but I think investors are going to be surprised just how far this dynamic goes. I think you could see PE ratios for companies like Microsoft, for example, going much, much, much higher. And I think TINA will be more evidence of the first theme where, it exacerbates that dynamic of the strong getting stronger and the winners in the market continuing to stretch out their performance. Now, some people would already sort of point to the behavior of, say, Tesla stock or the Nasdaq as a whole and say, well, this is clearly we're already in a bubble. This is exactly like the tech bubble from 20 years ago. So the evidence doesn't really point in that direction. This chart shows the ratio of the Nasdaq relative to the S&P 500. And in the late 90s, the Nasdaq outperformed the S&P 500 by roughly 3-to-1. So there really was a parabolic move that lasted just 2 years. It happened in a very, very compressed period of time. Since then, this ratio has taken roughly 17 years to reach its old highs. Now, if you look at the far side of it, on the right-hand side of the chart, COVID has caused this ratio to really, sharply rise. But I think it's really difficult to make the argument that we're in a bubble, certainly in tech stocks today, at least not on an aggregate kind of basis. Does it have the potential to get there? Potentially. And as I described before, I think one could say it's almost a rational bubble. But I think it's different from what we saw in the late 90s. So this chart, the red line, is Amazon's share price since it IPO'd in 1997. The dark blue line is the price that you could have paid and still earned a 10% return per year. So what I find interesting is, even at the height of the tech bubble, you could have paid 5 times or roughly 5 times Amazon's price at the time in the middle of a crazy bubble and still earned a 10% per annum return. So what this illustrates to me is the power of seeking out those 4% of companies that can really deliver outstanding returns and just really holding them for the long term. And I think that is more important than trying to call whether something is a bubble or not. And that's certainly what we try to do. So this is the Anchor Global Equity Fund. This is the we try to find these companies like Amazon. We try to find the multi-baggers, those 4% of companies. And so far it's worked out quite nicely, and particularly in this year. So we also offer a feeder fund. So following the webinar, if you have more interest in either of these two funds or the Global Tech Fund, please do get in touch with your platform provider or reach out to Anchor Capital.